Hi friends, this is Devon, founder and CEO of Choules Financial. On this week's Key to Yes, we're gonna go over strategic income in retirement. What does that mean to you? When it comes to retirement, which bucket do we take our money from? Do we take our brokerage accounts, our taxable accounts, our pre-tax accounts, our tax favored accounts? Where are we taking our money from to give us that income we need? And is there the ability to have a strategy to get more from less? And the answer is yes. We're gonna go over how taxes impact our income in retirement. Because remember, if we have more taxes, that means we have less income. So we want to make sure that we give you the best version, the best advice on how to get through retirement with giving the government the least and you getting the most in income. With that, we call it the tax triangle of how we save for retirement. We have our always bucket. When we put money in the always bucket, we always pay tax on it. Those would be things like our CDs, interest at the bank, okay? Rents. We're always paying taxes on those. Now, when it comes to taxes as we get into retirement as well, I'm gonna put in pensions, Social Security, income. You're gonna get a 1099 every single year telling you how much you owe on it. Some of these we can control, some of them we can't. We'll go through that in a little bit. On the later side of things, we have things like our 401k. We've never paid taxes on it, and we have to pay taxes later when we go to take the money out. But a 401k, there's also a 403b, a 457, a TSP, an IRA, basically anything that's pre-tax, something that we've never paid taxes on when it's been tax deferred. Later in life, we have to take that out. We already know that 73 equals RMD, required minimum distribution. We talked about that in one of our prior videos. If you don't know what that is, you can find it above in the videos. But when it comes to distributing our money, I forgot the most important part, the never again portion. Most people know that portion as a Roth IRA or 7702 subsection A as a really fancy way of saying permanent life insurance if you guys have that. These are places that are tax favored or can be never taxable again. So when it comes to spending money in retirement, it's not just as easy as 1, 2, 3, I'm gonna spend all my always money first, and then I'm gonna move to my later money when I'm forced to inside of it. Really what we're looking for is how do we take some from all three of these pieces in any given year to help control our taxes. We talked about in a prior video that your Social Security can be taxable as much as 0 to 50% to 85% based on the amount of taxable income you have. So we want to know which bucket we need to take from. As an example, if you are making less than $100,000 a year to live on in retirement, if you have money in a brokerage account over here in the always bucket, we can potentially take that out tax-free. And so there's a portion of this when it comes to taking out money in retirement. You've heard it before and you'll hear it again, that a plan is greater than a hope and that we need a written retirement income plan that tells us each year how much we should take from which bucket, because each one of these has an unintended consequence of when we take from each one of them. So when it comes to retirement and taking money out, the best piece is to create the written retirement income plan to know where we're going. But inside of it, there's things that we always know. We're gonna have our Social Security, we're gonna have pensions. We can't control any of that. Those are just the taxable piece. Those are the base. That's where we start at. And then depending on our total assets, where our money's at, we may take some from our 401k for the year. We may take our brokerage and our long-term capital gains and get it at a 0. Or get it at a 15% and get it at a reduced rate. The biggest piece is that we need to know what is the consequence of taking money from each one of these buckets. Now, obviously, if you have your money, the majority of it in CDs, interest, rents, 401ks, 403bs, 457s, TSPs, IRAs, when it comes to retirement, do you expect to pay less in taxes or more in taxes if more of your money is in the bottom half of the triangle? We're gonna pay more in taxes. So inside of this, I'm sure you've heard of it before, but we want to do Roth conversions and see how much money we can push to the top of this triangle where it's never again. Because if it's never again, means that our income is more secure, because it doesn't matter if the government raises taxes, lower taxes, they're off the bill. They're completely done. Now, with Roth conversions, there's a lot of things to take into calculation, like all your other income, where you're at, your tax bracket, are you on Medicare? So with that as well, we want to make sure we do incremental Roth conversions, not everything all at once. There's some rules to it that when you come in, we'll definitely go through all those pieces. Again, the portion that I talk about the most on my channel is typically taxes. I have a real passion for it, master's in accounting, emphasis in taxation, and it's simply based on the strategy to help my clients give less to the government and keep more simply by having a proactive tax plan and a written retirement income plan to make those things work. With this, I know I didn't answer a lot of this of which one do I take from, because it, as I said in the beginning, it's not as simple as 1, 2, or 3. Which bucket do I take from and when? It's why we have to build a written retirement income plan and know strategically which account we're taking from and why, and how to reduce what we give to Uncle Sam so that we can keep more. And if we don't spend it, we can leave more to our loved ones. All right, that's all I have for you this week on the Key to Yes. Thank you so much. So when it comes to retirement and maximizing your retirement income, the name of the game is a written retirement income plan with a proactive tax strategy. All right, folks, until next time, make sure that you subscribe down below, hit the notification button. We'll be back next week. Thank you.